Let's start with a number most people have never heard, and it should scare you more than any headline this year. As of this spring, the United States national debt passed the size of the entire American economy. Total public debt hit about $31.27 trillion. dollars. The whole economy, measured by GDP, produced about $31.22 trillion dollars over the same 12 months. That means the debt to GDP ratio crossed 100%. That has only happened one other time in American history, right after World War II. Back then, the number peaked around 106%, and the country spent the next 20 years paying it down to about 34%. This time, there is no war ending. There is no demobilization. There is no plan on the table to bring the number down. The Congressional Budget Office expects the ratio to keep climbing from around 101% this year toward 120% by 2036. Some measures, once you include state, local, and intergovernmental debt, already put the real number well above 120% today. The federal government is spending about $1.33 for every dollar it collects in revenue. That gap gets covered by borrowing roughly $50 billion every single week. You don't need an economics degree to know that a household spending 33% more than it earns every single week forever has a problem. Governments can push that problem further down the road than a household can because they can print the currency they owe the debt in. But pushing the problem down the road doesn't make it disappear. It changes what kind of problem it becomes. And that's really what this video is about. Not whether the debt gets paid back in some dramatic default. It's about the much quieter, much more common way governments have solved debt problems throughout history, and what that quiet solution does to anyone holding cash, bonds, or a retirement account that isn't positioned for it. There's a framework that a lot of macro investors use to think about this, built around the idea of long-term debt cycles. Ray Dalio, the founder of Bridgewater Associates, has written and spoken publicly for years about how these cycles tend to play out over centuries, and how the ending stages tend to rhyme even when the specific triggers are different. You don't have to take his word for it or anyone else's. The pattern shows up in the historical data regardless of who's pointing at it. When a government's debt gets large enough relative to its economy and interest payments start eating a bigger and bigger share of the budget, policymakers are left choosing between three unpleasant options. They can default outright, which is politically explosive and rare for a country that borrows in its own currency. They can restructure the debt, forcing lenders to accept less than they're owed, which is also rare outside of emerging markets. Or they can inflate the debt away, letting the currency lose value over time so that the debt shrinks in real terms, even though the dollar amount stays the same. Historically, governments that can print their own currency almost always lean toward the third option because it's the one that doesn't require an announcement. Nobody has to vote for it. It just happens gradually through monetary policy decisions that get explained in far more technical language.
Here's what that actually looks like in dollars. Say you owed $100,000 in a fixed obligation back in 2020. If the currency loses half its purchasing power by 2030 through a decade of elevated inflation, you still owe $100,000 on paper, but you're paying it back with dollars that buy half as much. The lender loses. The borrower wins. Now flip that around. If you are the saver, the person with cash in a savings account or a retirement fund parked in long-duration bonds, you are the lender in this scenario. Every year that inflation runs hotter than the interest you're earning, your real wealth quietly shrinks, even while the number on your statement goes up. This isn't a hypothetical happening somewhere far away. It's happening right now in the current data. The most recent reading on the Consumer Price Index showed inflation running at 4.2% over the prior year, the hottest reading in more than 3 years. Core inflation, which strips out food and energy, sat at 2.9%, still meaningfully above the Federal Reserve's 2% target. Shelter costs alone rose 3.4% over the year. In June, the Federal Reserve held its benchmark interest rate steady at a range of 3.5 to 3.75% for the fourth meeting in a row. That in itself isn't unusual. What was unusual is what happened underneath the headline decision. This was the first meeting under new Fed Chair Kevin Warsh, who took over from Jerome Powell in mid-May. And instead of signaling more rate cuts, which is what markets had expected for most of the year, the Fed's own projections shifted toward the possibility of a rate hike before year-end. 9 of the 18 voting members now see the policy rate holding steady or moving lower by December. 6 of them are penciling in 2 separate quarter-point hikes. The Fed's preferred inflation gauge, core PCE, was revised upward to 3.3% for this year, a full half-point higher than their forecast just 3 months earlier. Why the sudden shift? A big part of it traces back to the conflict between the U.S. and Iran that began in late February, which pushed oil prices above $100 a barrel and reignited inflation expectations that had been cooling. A ceasefire was announced in mid-June, and energy prices have come off their highs since, which gives the Fed a little breathing room. But the bigger story is this: a new Fed chair, installed specifically because the previous administration wanted lower rates, walked into his first meeting and instead delivered one of the more hawkish messages markets have heard in years. He used the phrase price stability 12 times in a single press conference. That's not the voice of someone trying to protect savers from inflation risk out of pure conviction. It's the voice of someone who knows the alternative, letting inflation run without a credible response, is a much bigger threat to the dollar's credibility than a few uncomfortable months of higher rates. This is exactly the kind of environment where gold and silver have historically done their job, not as speculative trades, but as the two assets that don't rely on anyone's promise to pay you back in dollars that are still worth something. Let's look at what they've actually been doing, because the last 18 months have been a genuine case study. Gold spent 2025 on a historic run, gaining roughly 67% over the year, one of its strongest calendar years in decades. That run kept going into early 2026, and gold hit an all-time high of $5,589 an ounce on January 28th. Since then, it's pulled back hard. Gold closed out the second quarter of this year at around $4,014, a 14% quarterly decline, the steepest quarterly drop since 2013. As of the start of July, it's trading around $4,026 an ounce. That pullback tracks almost exactly with the shift in Fed expectations we just talked about. When traders started pricing in a possible rate hike instead of cuts, gold, which pays no interest and competes directly with yield-bearing assets, gave back some of its gains. Silver's story over the same period is even more dramatic, and it's the part of this that most casual investors miss entirely. In April of 2025, the gold-to-silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, spiked above 100 to 1. Historically, that ratio trades somewhere between 50 and 80 to 1 over the long run. A reading above 100 is a statistical extreme, more than 2 standard deviations from the historical average. Extremes like that don't last. Every time the ratio has blown out past 80 in the past, silver has gone on to outperform gold sharply as the ratio compresses back toward its historical range. That's exactly what happened. By January of this year, the ratio had compressed all the way down to around 57 to 1, and silver hit an all-time high of $121.62 an ounce, gaining roughly 147% over 2025, more than double gold's already strong return. Then silver corrected hard too, falling 42% from that January peak as the same rate hike repricing hit precious metals broadly. As of the start of July, silver sits around $58 to $59 an ounce, and the gold-to-silver ratio has widened back out to roughly 68 to 1. That's still inside the historical 50 to 80 range, but it's meaningfully cheaper relative to gold than it was back in January. If you're someone who believes the structural case for precious metals, the debt load, the inflation pressure, the eventual return to a looser Fed policy stance once the current energy shock fades, then this pullback is the kind of moment that structural, patient investors have historically used to build positions, not the kind of moment that should scare you out of the asset class entirely. There's one more piece of data that doesn't get nearly enough attention, and it matters more than any headline about a single day's price move. It's not retail investors driving the long-term structural demand for gold right now. It's central banks. The World Gold Council published its 2026 Central Bank Gold Reserves Survey in June, drawing responses from 76 central banks, the highest participation in the survey's 9-year history. 89% of those central banks believe global gold reserves will keep growing over the next 12 months. A record 45% say their own institutions' reserves will specifically increase. These are sovereign, price-insensitive, multi-decade buyers, and collectively they've been accumulating gold at an average pace of about 1,000 tons a year for the past 4 years, roughly double the pace of the decade before that. Perhaps the most telling number in the whole survey, 74% of central bank respondents expect a moderate or significant decline in the dollar's share of global reserves over the next 5 years, and they specifically name gold as the primary asset benefiting from that shift. Half of them plan to fund new gold purchases through domestic programs denominated in their own local currencies, deliberately routing around dollar-denominated markets altogether. Think about what that means. The people managing sovereign reserves for entire countries, people who have access to information and analysis far beyond what any single household can gather, are making a coordinated structural bet that the dollar's dominance in the global reserve system is going to erode over the coming years, and that gold is the asset that fills that gap. They're not doing this because of a YouTube video or a countdown clock. They're doing it because they run the numbers on debt sustainability, currency stability, and geopolitical risk for a living, and the numbers point in one direction. So where does that leave an ordinary person trying to protect what they've built? Let's be honest about the historical precedent first, because it's more useful than any prediction about the future. In the 1930s, during the depths of the Depression and the debt deflation that followed the crash, the stock market fell close to 89% from peak to trough, and a wave of bond defaults wiped out investors who thought fixed income was safe. Gold, which the government had fixed in price, and which individuals were eventually required to exchange for currency under executive order, still ended up being one of the few stores of value that preserved purchasing power through that period, largely because the government itself revalued gold sharply higher relative to the dollar as part of its recovery strategy. In the 1970s, a different kind of crisis played out. Bonds lost roughly 60% of their value in real inflation-adjusted terms over the decade. The stock market went essentially nowhere for 13 years once you adjust for inflation. Gold, meanwhile, went from $35 an ounce, where it had been fixed for decades under the Bretton Woods system, to a peak of $850 an ounce by the end of the decade, after the U.S. ended dollar-to-gold convertibility in 1971 and inflation ran hot for years. Energy companies, which benefited directly from the inflationary pressures crushing everyone else, saw revenues climb by hundreds of percent over the same stretch. Neither of those decades looked exactly like this one. The specific triggers were different, the starting debt levels were different, the global monetary system was different. Nobody, including people who study this for a living, can tell you with precision what the next 10 years look like or exactly when the next inflection point hits. What history does show, fairly consistently, is that in periods where governments face unsustainable debt loads and choose inflation as the least politically costly way out, hard assets that can't be printed have tended to hold or gain purchasing power, while cash and long-duration fixed income have tended to lose it. That's not a guarantee about the future. It's a pattern worth understanding as you think about how your own money is positioned. Now let's talk about what that actually means in practice. because understanding the macro picture is only useful if it changes what you do with it. This isn't a stock pick, and it isn't a countdown to some specific date. It's a framework for thinking about diversification when the two traditional safe assets, cash and government bonds, are the two assets most directly exposed to the inflation-driven solution we just walked through. Physical gold and silver are the most direct way to hold an asset that isn't simultaneously someone else's liability. When you own a gold coin or a silver bar outright, there's no counterparty who has to make good on a promise for that asset to retain its value. That's different from owning shares in a gold mining company or a paper gold contract, both of which carry their own operational and counterparty risks on top of the metal price itself. The trade-off with physical metal is storage, insurance, and the fact that it doesn't produce any income while you hold it. For people who want exposure to the metal price without the logistics of physical storage, fully allocated trusts that hold real, segregated bullion, distinct from paper futures contracts that can be diluted, are generally considered the closest paper proxy to owning the metal directly. Beyond precious metals, businesses with real pricing power, the kind that can raise prices in line with or ahead of inflation without losing customers, have historically held up better than businesses without that power during inflationary stretches. Think consumer staples with strong brands, energy producers, and infrastructure companies with contractually protected revenue. These aren't inflation hedges in the pure sense that gold is, but they've historically outpaced companies that can't pass rising costs onto customers. Short-duration government instruments are worth understanding too, even though they sound boring next to gold and silver. The reason they matter right now specifically is that with the Fed's policy rate still sitting at 3.5 to 3.75%, short-term Treasury bills are paying a real yield that's at least partially offsetting today's inflation rate, something long-duration 30-year bonds are not doing nearly as well, since those get hurt the most if rates end up rising further from here. Exactly the scenario the Fed's own June projections just opened the door to. And then there's simply understanding your own timeline. If you're decades away from needing this money, temporary drawdowns in gold and silver like the pullback we've seen since January matter far less than the underlying structural trend. If you're close to needing the money, the calculus is different, and that's a conversation to have with a licensed financial advisor who knows your specific situation, not a YouTube video. Let's slow down on the 1970s for a minute, because it's the closest historical analog we have to a modern fiat currency economy dealing with a debt and inflation problem at the same time, and the details matter more than the headline number. The decade didn't start with an inflation crisis. It started with a currency decision. In August of 1971, facing a growing gap between the amount of dollars in circulation and the gold the U.S. Treasury actually held, President Nixon suspended the ability of foreign governments to convert dollars into gold at the fixed rate that had anchored the global monetary system since the end of World War II. That single decision, often called the Nixon shock, effectively ended the last formal link between the dollar and a hard asset. The dollar became what's called a pure fiat currency, worth whatever the market and the government's credibility said it was worth, with nothing physical backing it. Inflation, which had been creeping up through the late 1960s because of Vietnam War spending and expanding domestic programs, accelerated sharply once that anchor was gone. By 1974, inflation was running above 11% a year. The Fed under Chairman Arthur Burns raised rates, then backed off too early under political pressure, and inflation reaccelerated even worse by the end of the decade, eventually peaking above 13% in 1979 and forcing his successor, Paul Volcker, to push the federal funds rate above 19% to finally break T. He cycled, triggering a sharp recession in the process. The people who came through that decade with their purchasing power intact were not generally the people holding cash in savings accounts or long-term government bonds. Savings account yields lagged inflation for most of the decade, meaning anyone keeping their emergency fund or retirement savings in cash was quietly losing ground every single year even as their account balance grew. Long-term Treasury bonds were even worse, because rising interest rates crushed the market value of existing bonds that were issued at lower pre-inflation rates. Someone holding a 30-year bond purchased in 1965 at a low fixed rate watched its market value collapse over the following 15 years as new bonds were issued at much higher rates to compensate for inflation. Meanwhile, gold's moved from $35 to $850 an ounce, even after accounting for the fact that some of that move reflected catching up to a price that had been artificially fixed for decades, still represented a real, inflation-beating return that most paper assets simply couldn't match. There's a version of this story that's less well-known, and it's about who got hurt worse. People close to retirement in 1970 who had done everything conventional advice told them to do. They'd built a portfolio of high-grade bonds and blue-chip stocks, the standard prescription of the era, expecting steady, predictable income through their retirement years. Instead, they watched inflation erode the purchasing power of their fixed bond income year after year, while the stock market, measured in real terms after inflation, went essentially nowhere for the entire decade. $1 of retirement income in 1970 bought roughly 40 cents worth of goods by 1980. That's not a market crash in the traditional sense. Nobody rang a bell. There was no single day where the headline said markets crash. It was a slow, compounding erosion that most people didn't fully register until they tried to buy something and realized how much less their money covered than it used to. That's precisely the mechanism worth understanding today, because a headline crash is easy to see coming and easy to talk about. A decade of currency erosion is much harder to notice while it's happening, and much more common historically than an outright default. Now here's a practical way to think through your own exposure to this kind of risk, broken into a few concrete steps rather than abstract advice. The first step is simply figuring out your own timeline. How many years until you actually need a meaningful portion of your savings, whether that's for retirement, a home purchase, or another major goal? Someone with 30 years until retirement has an entirely different risk tolerance for short-term volatility in gold and silver than someone who needs to draw down savings within the next 5 years. There's no universal right answer here, only the right answer for your specific timeline, and that's genuinely worth working through with a fee-only financial advisor who has no incentive to sell you a specific product. The second step is understanding what you actually own right now at the asset class level, not just the account level. A lot of people who think they're diversified because they hold several different mutual funds discover, when they actually look under the hood, that those funds all hold overlapping exposure to the same handful of large companies and the same duration of bonds. Pulling up your last few account statements and categorizing what you hold by asset class, cash, short-term bonds, long-term bonds, U.S. stocks, international stocks, real assets, is a useful exercise precisely because most people have never actually done it. The third step is recognizing that adding exposure to hard assets doesn't have to mean an all-or-nothing bet. Financial advisors who work with precious metals as part of a diversified portfolio commonly discuss allocations in the range of 5 to 15% of total portfolio value across gold and silver combined, with gold typically making up the larger share given its lower historical volatility, and silver as a smaller, higher beta complement given its steeper swings in both directions, which we've clearly seen over just the past 18 months. That's a meaningfully different conversation than the idea of moving your entire portfolio into metals, and it's worth stress testing against your own risk tolerance rather than adopting a number from a video. The fourth step, and probably the most overlooked one, is simply paying attention to Fed policy in a structured way instead of reacting to headlines. The Fed publishes its policy statements and its summary of economic projections after every meeting, both freely available on the Federal Reserve's own website. You don't need to be an economist to read the actual language used around inflation, employment, and the balance of risks. What we saw in this June's meeting, a chair walking in expected to cut rates and instead delivering a message about price stability followed by projections that open the door to a hike, is exactly the kind of signal worth tracking over the coming months, because it tells you far more about where policy is actually headed than any single data point in isolation. It's worth pausing on why silver specifically behaves so differently from gold, because that's the piece most people watching a gold price chart completely miss. Gold is, first and foremost, a monetary asset. Central banks hold it, investors buy it during uncertainty, and relatively little of the annual supply gets consumed industrially. Silver is something stranger. It's both a monetary metal with the same safe haven appeal as gold, and an industrial commodity that gets used up in electronics, solar panel manufacturing, and medical equipment because of its unmatched electrical conductivity and reflectivity. That dual identity is exactly why silver's price swings are so much sharper than gold's in both directions. When fear and safe haven demand dominate, silver rides gold's coattails higher, but with more leverage because the silver market is far smaller than the gold market, and it doesn't take as much investment money flowing in to move the price. When industrial demand from sectors like solar accelerates, that adds a second demand driver on top of the monetary one, something gold simply doesn't have. And because most silver isn't mined on its own, it comes out of the ground as a byproduct of mining copper, zinc, and lead. Supply can't respond quickly to a price spike the way it can for a commodity that's mined directly. Miners aren't going to open a new copper mine just because silver prices went up. The silver they produce is essentially a side effect of decisions made for entirely different reasons. That combination, inelastic supply plus a dual source of demand, is the mechanical reason silver has historically moved so much further than gold once a precious metals cycle gets going, and also why it falls harder once sentiment turns. Exactly what we've seen with the 42% drawdown from January's peak. If you're trying to make sense of where things stand right now rather than where they've been, the gold-to-silver ratio itself is one of the more useful tools for that, precisely because it strips out the noise of the dollar's overall strength or weakness and just asks, relative to each other, which metal is cheap? Over the last 50 years, that ratio has averaged somewhere around 65 to 1. When it climbs meaningfully above 80, meaning gold has gotten expensive relative to silver. That's historically marked a point where silver was undervalued and due to catch up, which is exactly what happened after the ratio spiked past 100 in April of last year. When the ratio falls meaningfully below 50, meaning silver has run up faster than gold, that's often marked the opposite, a point where silver had gotten ahead of itself and gold looked comparatively cheap, which is roughly what happened around January of this year when the ratio bottomed near 50. Sitting at around 68 to 1 today, the ratio is back inside its long-run historical range, no longer flashing an extreme signal in either direction. That doesn't tell you what happens next. It just tells you that, unlike a year ago, the relative pricing between the two metals isn't currently sending an unusually loud message on its own. The debt, the inflation data, and the Fed's posture are doing more of the talking right now than the ratio is. For anyone who decides this is worth acting on, it's worth understanding the actual mechanics of how people get exposure to these metals, because the options carry genuinely different trade-offs, not just different levels of convenience. Buying physical coins or bars from a reputable bullion dealer gives you the most direct exposure, with no counterparty standing between you and the metal, but it comes with real costs. A premium over the spot price when you buy, a discount when you sell, and the ongoing question of secure storage, whether that's a home safe, a bank safe deposit box, or a paid third-party vault. Exchange-traded funds that hold physical, fully allocated bullion offer a middle path, trading like a stock in a normal brokerage account with no storage logistics, though they carry a small annual management fee, and depending on the specific fund structure, some funds hold allocated segregated metal, while others rely more heavily on unallocated claims or futures contracts, which reintroduces some of the counterparty risk that physical ownership avoids. Mining company stocks are a third option entirely, offering leveraged exposure to the metal price since a miner's profit margin expands faster than the metal price itself when prices rise. But that leverage cuts both ways, and mining stocks carry company-specific risks, operational problems, geopolitical exposure in the countries where they operate, and management decisions that have nothing to do with the price of gold or silver itself. None of these is objectively the right choice. They're different tools for different priorities, whether that priority is minimizing counterparty risk, minimizing cost and hassle, or maximizing potential upside in exchange for taking on more volatility and more risk. None of what you just heard is financial advice, and it isn't a prediction dressed up as a certainty. It's a walk through real, publicly available data, the actual debt-to-GDP ratio, the actual Fed decision from last month, the actual gold and silver price action of the past 18 months, and the actual historical precedent from the two clearest debt cycle endings in the last century. What you do with that information is your call, and it deserves more thought than a 5-minute video can give it. But the raw material, the debt load, the inflation reading, the Fed's own pivot toward a more hawkish stance, and the central banks quietly building gold reserves at the fastest pace in decades, that's not speculation. That's what's happening right now, and it's worth understanding regardless of which asset you ultimately decide to hold.